One of the most important aspects of options trading, and one that I've been paying close attention to as of late, is volatility. Now, volatility is the measurement of price fluctuations in an asset that can greatly impact options prices. But did you know that you can use volatility to your advantage in your own options trading? That's right. And in this video, I will show you how to use volatility to your advantage and make the most out of your options trades. First, we need to understand what market volatility is and why it's important in options trading. Now, high volatility means high options prices. Now, we're going to relate this all back to the VIX. So the VIX, which is the volatility index on the S&P 500, it measures 8 optionable stocks, the volatility of those positions, and it gives a point on a chart, just like you would a price graph of an Apple or a Microsoft or whomever. And what happens is when the volatility goes higher, when fear goes higher, high fear equals high options prices. Low fear equals low options prices. Now, high fear, high volatility, or high VIX is not necessarily a bad thing, right? If you are a buyer, you want to have very low volatility. If you're a seller, you want to have a higher volatility. We don't want crazy, nutty, stupid volatility. We're at 90. We've been near that before, right? So we want to get more of on the VIX, I like that 18 to 29 range. For me personally, is the VIX level I like because that works well for me as a buyer and a seller at the same time. Now that we understand what volatility is, let's talk about how it impacts options prices. Option prices are determined by several factors, including the underlying asset's price, time until expiration, and volatility. The higher the volatility, the more expensive options prices become. This is because there's a greater chance for price swings and larger potential profits. So traders are willing to pay more for those options. So as an example, if you took a SPY, the SPY, which is an ETF that tracks the S&P 500, the ticker symbol is SPY. That's going to have usually a fairly low volatility comparative to the overall market. So to look at volatility a little bit, let's do a comparison of the SPY, which is an ETF that tracks the S&P 500. And we're going to compare it to an individual stock such as, how about GameStop, right? Remember the craziness with Wall Street bets and what was going on over there, right? How flippin' crazy those prices were going, up to $2, $3, $4 $100 per share out of nowhere, right? So that volatility was very high, and because there was a lot of vol in there, it drove prices through the roof. There was one individual that called my house, said they wanted to buy it. I told them not to buy it. They did it anyway. They bought it at hundreds of dollars a share, and I think it's now trading at, $20 or so a share for the stock. So they definitely got stopped because of not understanding how to trade volatility. So let's talk about how you can use volatility to your advantage in your own options trading. Now, there are several strategies that you can use to profit from volatility, such as selling options, trading options with a high implied volatility, and using volatility as an indicator for future price movements. For example, if you sell options, you believe that the underlying asset's price will remain stable and the option will expire worthless. This is known as a volatility crush and can result in substantial profits for the option seller. Another strategy is to trade options with a high implied volatility. Now, implied volatility is the market's expectation of an asset's future volatility. If the implied volatility is high, that means that the market is expecting large price swings in the future. And you can use this information to your advantage by either buying or selling options. And lastly, you can use volatility as an indicator for future price movements. So if the volatility is high, it's a good indicator that the market is uncertain and there's a greater chance for price swings. This can help you make informed decisions about when to enter or exit a trade. In conclusion, volatility is an important aspect of options trading and can greatly impact options pricing. But by using volatility to your advantage, you can make the most out of your options trades, whether it's selling options, trading options with high IVs, implied volatilities, or using volatility as an indicator for future price movements. There are several strategies that you can use to profit from volatility. This all goes to show you that a volatile market doesn't mean it's something you have to shy away from when it comes to trading. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Keep your training going by clicking here.